Let's get more on today's sell-off. Our next guest says today's drop is a perfect buying opportunity. Let's bring in Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, why?
Well, Mel, actually, we've been using S&P 3000 as our pullback point to get more offensive. So, we're within 50 point of that. And just to be clear, just because we pick a point doesn't mean you can't blow through it. But to exactly what was just said, the things that are in place, there were three things that really drove that final leg lower in March. And it was you had no idea what COVID-19 was. You had no idea what the economic impact was going to be and how long a shutdown would last. And you had no idea what the monetary policy was going to look like coming out of it. And, what that uncertainty in those areas now have some visibility. So Karen had mentioned monetary and fiscal policy is going to continue. We know that we believe that a vaccine and a treatment should at least be announced and exist at some point this year. The market has been driven by monetary policy. So based on the economic data, based on the monetary policy, and based on the science of trying to find a vaccine and treatment, in our view, you want to be a buyer of weakness.
What areas would you buy?
So it's the most insane thing to say, I think, on the planet. But when we turned offensive, it was based on the economic reopening trade. So if you believe that the Fed is going to continue the stimulus, and by the way, it has been extraordinary. You have never seen this kind of money supply growth in our history. You have never seen this kind of excess liquidity, which is the money supply plus other liquid assets against what you need to actually grow the economy. And you've never seen the promise of a Fed to just look into a camera on CBS's 60 Minutes and say, we're just printing money. So with that backdrop, it ultimately comes down to what Karen mentioned, the vaccine and the treatment. If you get that vaccine, it's like a light switch could go on. The challenge that I think the market has, Mel, is that it's trying to figure out, number one, what multiple do you pay for a Fed to the infinity? Right? You can, I've said on the show so many times, you can't fix debt with exponentially more debt, but I guess you can fix it with infinitely more debt, which is the current game plan. He told us not to worry about that for the foreseeable future. So I believe it's got to be the economic reopening, which has been correcting since we've been looking for this consolidation since June 5th. It's actually interesting, Mel. As of today, as I look at my screen, 56% of S&P components are trading above their 200 or their 50-day moving average. It was 97% last Tuesday. So today isn't the only correct. It's been correcting over the last couple of weeks, and it just is showing up in the index today.
Hey, Tony, it's Dan. How are you, bud?
Dan, how are you, bud?
All right, quick one here. All right, the banks. We have the J.P. Morgan indicator. It acts horrible. The money center banks act horrible. How do you justify the price action there? Forget about what the Fed's doing. Forget about the yield curve. What is it saying to you about the back half of the year or the prospects of a 2021, just a real recovery that starts to build on itself? Is it starting to price in higher unemployment, greater defaults, just a weaker than expected economy than the stock market at these levels is telling you?
Well, it depends on what bond market, Dan. To your point, the 10-year Treasury is telling you there's going to be a very lame recovery. The bank stocks are telling you it's going to be a pretty meek lending environment. But on the other side, you have historical corporate credit new issuance. Well over $1 trillion has been raised. You've got the money supply numbers growing in the 20%. I mean, it is bananas relative to any other period in our country's history. So it depends on what stimulative effect of money happens. And here's the thing about the banks. People, when the market was going higher, before that 60 Minutes interview by the Fed, I believe Powell was on there in part because the banks were actually retesting the low. If you remember the Thursday before that 60 Minutes interview where he talked about just printing money and there's no reason to expect it to stop anytime soon, right before that last Thursday, Wells Fargo was rumored to be having to cut their dividend and maybe even being acquired by Goldman, and the KBW Bank Stock Index was literally testing its low. And then they just gripped it higher because of that Fed, where it understood that the Fed is going to print money until they get their two mandates. I mean, how many times have I been on the show and I've looked into the camera and I said, the guys printing the money are telling you what they're going to do. And he is very clear in his intention, and it was after that that the banks rallied from what looked like it was a horrible, horrible position. I think you could be lining up for similar in the banks and the industrials and some of the economic sensitive areas that have already corrected.
Tony, always great to speak with you. Thank you.
Thank you, Mel.
Tony Dwyer, Canaccord Genuity. So Jerome Powell saved the banks and the markets. Guy, why don't you believe that Powell has the power anymore? I mean, the Fed managed to lift us off of the March 23rd lows. Why don't you believe him even now?
No, I should believe him, absolutely. I mean, so many people have said, why make this more complicated than it has to be? Tony Dwyer at the head of that list, David Tepper spoke about that years ago. I totally get it. I mean, why fight what is clearly their mandate? And their dual mandate, by the way, is to make sure the S&P 500 and the NASDAQ goes higher, in my opinion. And that's something I'm still entitled to. With that said, you hit a point of diminishing marginal returns with these actions. And I think we're getting close to it. And by the way, Dan mentioned, the dollar had a bit of a rally. You start seeing weakness in the dollar, and people might tell you how bullish that's be. I think that could be extraordinarily bearish. And just watch the U.S. dollar here. The U.S. dollar has been weak. If that weakness continues, I do not think this time that's bullish for equities. And that falls at the feet of the Federal Reserve.